The committee will come to order, and without objection, the Chair is authorized to declare a recess of the committee at any time. I will note that we have been told to expect votes sometime between 3:15 and 3:45. This hearing is entitled The Impact of the International Monetary Fund, Economic Stability or Moral Hazard. And I now recognize myself for as much time as I may consume to give an opening statement. Today we'll examine closely U.S. contributions to the IMF, the International Monetary Fund, and the role that the IMF plays in terms of global financial surveillance, technical assistance, and of course lending. Although the IMF membership is comprised of 188 countries today, the U.S. is the biggest contributor to the IMF, accounting for more than 17% of its quota resources. If a major default were to occur, it could put U.S. taxpayers on the hook for billions of dollars. Since the global financial crisis of 2008, there has been an increased attention on the IMF's activities and their role in the global economy. In recent years, the IMF has bent the rules multiple times as it relates to exceptional access. The most egregious was the loan to Greece, which was 3,212% of Greece's quota. I will note, well above any of those quota norms. We wouldn't let a bank in this country make a loan of this exorbitant in nature. So why does the IMF believe American taxpayers should back a loan that, by our nation's standards, should not have been made in the first place? In 2009, Congress authorized a $100 billion commitment to the IMF in an account called the New Arrangements to Borrow. For the past 5 years, the Obama administration has requested $63 billion of that authorization to be transferred to a permanent paid-in capital account. This would still leave billions in the NAB account, and even though the NAB account is supposed to only be temporary. Now, why should hardworking American taxpayers' dollars be used to bail out other countries, especially after suffering from bailout fatigue in our own backyard? If you'll recall, the American taxpayers were forced to bail out such entities as Fannie Mae, Freddie Mac, and the Federal Housing Authority. Instead of furthering the bailout culture, wouldn't it make more sense for the United States to encourage advanced nations receiving loans from the IMF to better manage their spending and borrowing? Currently, every dollar the Congress sends to the IMF implicitly condones the IMF sending money from countries struggling to find their economic footing to nations in danger of squandering their inheritance. To be more direct, the use of the IMF as a backstop for advanced European countries calls into question, in my mind, whether this institution has become an enabling crutch instead of a helping hand. As we know from our experiences in this country, guarantees and bailouts can create moral hazards. Even for the most advanced nations, the freedom to succeed requires the freedom to fall and get back up again. I look forward to a meaningful discussion on the International Monetary Fund, and I look forward to hearing from our witnesses today. With that, I yield back the balance of my time, and I will recognize my ranking member, Ms. Moore from Wisconsin.
Thank you so much, Mr. Chairman, and I want to thank you for calling this hearing. It's a very important hearing, and it's a subject that certainly deserves congressional attention. We are increasingly in a global world, for all that means good and bad. And so I think the importance of the mission of the IMF has only been elevated. From the onset, let me say that I think that the United States Congress needs to immediately move to ratify the new IMF quota system. There is broad agreement that it is the rational move, and it has been agreed to. U.S. leadership and engagement in economic policy is vital in the long-term interest of our country. Global economic stability is, as we all know, smart geopolitics. Our borders are no longer a guarantee that what happens in far-off lands does not impact our shores, economically or otherwise. Congress's lack of action has hurt U.S. standing internationally. Further delay makes even less sense as China moves to fill the vacuum created by the lack of action by this Congress. I know that one of our witnesses wants to tie approval of the quota system to other IMF reforms, and I respectfully disagree on that point and welcome the engagement on that, while being entirely open to considering the case for IMF reforms, but not necessarily to making approval of the quota system contingent on acceptance of these yet-to-be-debated reforms. First, Time is of the essence, given the delay we've already seen. And secondly, I think it would be an act of bad faith to hold this agreed-to quota realignment hostage to unspecified secondary demands. Finally, I want to say that I think that the U.S. Fed, Treasury, and Financial Stability Oversight Council are great, but I think that IMF remains an important second set of eyes in global stability, and I think that the advice and stability role that they fill provides a valuable service to the United States and to the world. And, Mr. Chairman, I would yield back.
Gentlelady yields back. And with that, we are going to start with our testimony. The order here will be Mr. Lowry, and then Ms. Lunzager, and then Mr. Taylor. And Clay Lowry, who is the Vice President of Rock Creek Global Advisors, joins us today. He had served as the Assistant Secretary for International Affairs at Treasury Department from 2005 to 2009. And currently with Rock Creek Global Advisors, he consults on sovereign debt, exchange rates, investment policy, financial regulation, and he's currently advising multinational companies and financial institutions and trade associations on these matters. So with that, Mr. Lowry, we appreciate you being here and recognize you for 5 minutes. You need to make sure that you hit that button right in front of you. There we go.
Thank you very much, Chairman Izinga and Ranking Member Moore, as well as the other members of the subcommittee. And I want to thank you for this opportunity to testify on the IMF. I'm honored to be testifying alongside John Taylor, who is not only my former boss, but he's one of the most important macroeconomic thinkers in the United States, as well as with Meg Lunzager, who is a long-term colleague and very deeply knowledgeable about the IMF. The IMF promotes 3 objectives: macroeconomic stability, financial stability, and economic growth, using 3 basic tools: technical assistance, surveillance, or basically evaluation of a country's financial policies and economic policies, and lending. And when the IMF lends money, a country is usually in very deep financial trouble. To protect itself from this highly risky form of lending, the IMF relies on 2 things. 1, a presumption that its credits are senior to other credits. And 2, it requires that the borrowing country undertake reforms to alleviate the concerns of throwing good money after bad. As you can imagine, these things can be controversial, as we are currently seeing in Greece. The IMF finances itself through contributions by member countries, which are called quota. That takes into account a country's relative economic size. So, for instance, instead of being one country, one vote, as is the case in many international institutions, the United States has roughly 17% of the voting share. No other country is even close. Japan is second with around 6%. The IMF has evolved over the last 70 years, but one area that has harmed it in its legitimacy and its relevance was a representation structure that no longer fit the international economy. And so from 2005 through 2010, both in the Bush administration and the Obama administration, the U.S. led an effort to try to fix this problem. The 2010 agreement is the culmination of these efforts. First, it alters the voting weights to make adjustments so that countries such as China and Mexico and Korea will see their votes increase noticeably, while others will fall. The United States will basically stay the same. Second, it alters how voting shares are translated into board seats. There are 188 members in the IMF, but only 24 board seats. Europe disproportionately holds too many seats. After the reform package will be put together, we'll see dynamic emerging market countries have more seats, Europe will have less seats, the United States will still have its seat. The quota reform also doubles IMF quota resources, as the Chairman noted. It does this by reallocating money from an emergency pot of money, called the New Arrangements to Borrow, to the normal IMF pool of money, based on quota allocation. For the United States, we will not increase our total contribution to the IMF, but instead we'll transfer a portion of our NAB contribution to quota resources. This allocation requires authorization and appropriations from Congress. And to date, every major country has ratified this quota reform package except for the United States. So there are many economic and financial reasons for why we should support the United States, and it's probably not surprising to you that every Secretary of Treasury, most U.S. trade representatives, and the Federal Reserve Chairman since the Carter administration have supported this IMF reform package. But maybe just as importantly, the IMF is a foreign policy tool that the United States has called upon many times to provide finance and advice, whether it was South Korea in the 1990s, Afghanistan and Iraq in the 2000 period, or Ukraine today. But I can provide you a more personal example of this. In 2008, I worked for many hours with the Prime Minister of Georgia after his country was invaded by Russia. He was worried about a banking crisis and he was looking for liquidity. While the U.S. was very supportive of Georgia, we were in the midst of our own financial crisis in 2008 and were not in a position to provide emergency liquidity. Instead, we worked with the IMF, which stepped up very quickly to provide the financing Georgia needed to preserve confidence in its banking system and save its economy. In other words, the IMF is an important tool to conduct strong foreign policy and to provide the conditions that assist in keeping our troops out of harm's way. Don't take my word for it. Most of the Secretaries of Defense, National Security Advisors, and Secretaries of State from President Nixon through Obama have supported the legislative request of this administration. They recognize that U.S. leadership in the IMF is not only vital to the institution, but also important to our own national security interests. The IMF is far from perfect and will continue to need U.S. leadership to reform and evolve. However, U.S. leadership cannot occur from the sidelines and must come in the form of strong legislation with appropriate conditions. Therefore, I ask that Congress work with the administration and join what I believe is a strong bipartisan consensus and demonstrate this leadership. Thank you. I'm happy to answer any questions.
Thank you, Mr. Lowry, and the gentleman yields back his time. With that, we will go to Ms. Meg Lunzager. She's a public policy fellow at the Woodrow Wilson International Center for Scholars, and she currently consults on international economic, financial, and regulatory issues. And while the United States Executive Director on the IMF Executive Board from 2007 through 2014, she focused on achieving effective IMF input into lending programs in Europe, securing adequate IMF resources, supporting low-income countries, and strengthening IMF oversight of exchange rate policies. And with that, Ms. Lunzager, we appreciate you being here and recognize you for 5 minutes.
Thank you, Chairman Huizinga, Ranking Member Moore, and members of the committee for inviting me today. During my 14 years at the IMF, I represented 3 presidents, nominated first by President Clinton, then by President Bush, and continued to serve under President Obama. I'm currently a public policy fellow, and I should just note that my views today are my own and not those of the Wilson Center. During the global financial crisis, the IMF was instrumental in helping many countries recover and return to private market financing. The IMF draws on many members to provide financing, keeping the U.S. share a little bit above 20%, as Mr. Lowry was just describing. Nonetheless, U.S. leadership was crucial to bringing together all the elements needed for the IMF's international response. But that leadership is eroding as the United States delays approving the 2010 quote and governance reforms. The United States has the largest single country vote in the IMF, with a veto over key decisions, such as amending the articles and increasing IMF financing. This current voting structure, though, doesn't really represent the rapid growth in emerging markets and developing countries, so we have Belgium with a larger vote than South Korea, Mexico, or Turkey, quite anomalous. The United States recognizes distribution of voting power threatened to undermine the legitimacy of the United States, of the International Monetary Fund, and beginning in 2006, the Bush administration proposed steps to realign quotas, and in 2010, IMF members reached a broader agreement, which now awaits U.S. approval. Today's hearing presents an opportunity to clarify the elements of the 2010 package, and I've provided many details in my written statement. First, the U.S. share will remain comfortably above the 15% veto threshold, and as you, Mr. Chairman, and Mr. Lowry explained, there's no change in the U.S. financial commitment, with the shift coming from the new arrangements to borrow and being shifted to the quota. But Europe's voting share will decline, and dynamic emerging market share will increase. These changes should help keep global economic policymaking centered in the IMF, and key U.S. allies will gain, including Mexico, South Korea, Poland, the Baltic nations. Second, some claim the IMF should not have rescued Eurozone countries. But without the IMF as the crisis manager in Europe, I believe we risk the dissolution of the Eurozone, which would have reduced U.S. exports and increased the risk of European bank failures, ultimately affecting U.S. financial institutions and corporations, as well as our stock and bond markets. The U.S. economic recovery would have been undercut. Did the IMF ability to lend large amounts incentivize Eurozone countries to mismanage their finances and slide into crisis? That hardly seems likely, as evidenced by the very demanding policy adjustment programs they've had to implement. Countries avoid turning to the IMF until no other option remains. And while some investors might seek high returns in higher-risk countries, thinking that IMF lending will finance their exit, those illusions should be dissipating, as some countries resort to capital controls and others turn to debt restructurings. Third, over the many decades of the IMF's existence, U.S. leadership and ideas has persuaded others to join in promoting reforms. The United States has been a leading voice for accountability, transparency, and change, both at the institution itself and within member countries. U.S. initiatives at the IMF have led to much more openness in government accounts, sounder financial institutions as countries improve regulatory oversight, reductions in the financing channels for money launderers and terrorists, and improved economic growth and stability in low-income countries. Furthermore, important U.S. national security priorities were supported by IMF lending programs and technical assistance for Iraq, Afghanistan, Tunisia, Jordan, among others. More recently, the IMF responded to U.S. calls to increase support for the Ebola-affected countries in Western Africa and to underpin economic reforms in Ukraine with vital financing in the face of internal conflict and Russian economic pressure. Sadly, U.S. leadership continues to erode as the United States delays approval of these reforms. In my last months at the IMF, it became increasingly clear that other countries had little enthusiasm for U.S. proposals, such as extending the 0% interest on low-income country loans. The IMF, let me just turn to a key financing issue. The IMF has a backstop of numerous bilateral loan agreements with a subset of nations. I fear that if the United States does not ratify the 2010 reforms, strengthening the IMF's core capital, the IMF will continue to seek bilateral loans negotiated with less transparency and without U.S. involvement. These decisions should be made around the board table with all of us there. Thank you very much, Mr. Chairman, and I look forward to your questions.
Thank you. And with that, we turn to Professor John Taylor. Professor Taylor has a very long and impressive career, including many books and articles. He is currently the Marion Robert Raymond Professor of Economics at Stanford University and the George P. Schultz Senior Fellow in Economics at the Hoover Institute. He's known for his research on the foundations of modern monetary theory and policy, which has been applied by central banks and financial market analysts around the world. And specifically related to this, for 4 years, between 2001 and 2005, Professor Taylor served as the Undersecretary of Treasury for International Affairs, where he was responsible for currency markets, trades, and financial services, foreign investment, and then also the IMF and the World Bank. And with that, we welcome you, Dr. Taylor, again here to this committee, and you are recognized for 5 minutes for your opening statement.
Thank you, Mr. Chairman. Ranking Member Moore, other members of the committee. For the IMF to achieve the goals that Clay Lowery mentioned, such as economic stability, it really has to have a clear and predictable framework or strategy for carrying out its goal. Otherwise, decisions become highly uncertain. They lead to excessive risk-taking and international spillovers. I think a framework like that also provides for transparency and accountability. A number of years ago, such a framework called the Exceptional Access Framework was adopted by the IMF. It set forth criteria that had to be met before the IMF could lend exceptionally large amounts to countries. The most important criterion said that the IMF could not make new loans to countries with unsustainable debts. The expectation was that this way of limiting loans would reduce bailouts of the private sector, contain moral hazard, lower uncertainty, reduce the recipient country's debt burden, encourage more responsible fiscal and monetary policy, reduce spillovers, improve accountability, and therefore create more economic stability. And in fact, the introduction of this framework was accompanied by many such changes. Compared with the 80s and 90s, there were a few crises emanating from the emerging markets in the years that followed, and emerging market countries weathered the global financial crisis remarkably well, and economic policy in those countries generally improved. Unfortunately, this exceptional access framework is no longer in place. It was abandoned in 2010 when the Greek sovereign debt crisis emerged, and the IMF staff could not establish that the Greek debt was sustainable with high probability. So the IMF simply changed the rule. It wrote in an exemption saying that new loans could be made in unsustainable situations so long as there was a, quote, high risk of international systemic spillover. That exemption is still in place. As is well known, events in Greece following the 2010 decision have not been pleasant, and it is time, in my view, to reform and strengthen that exceptional access framework. A starting place would simply be to repeal the exemption for systemic risk. That exemption is the problem, not the solution. I have found much support for this kind of reform in the international community, including at the IMF. Importantly, for the Congress, this reform is closely related to the quota and voting reallocation agreement that Meg and Clay just mentioned, negotiated way back in 2010. This agreement would sensibly reallocate voting shares to give more votes to countries that have grown more rapidly. It would also increase the total quota commitment to the IMF. The main rationale for that increase is that the global economy and capital flows have expanded. Of course, the increase in the quota must be scored by the CBO and may need offsets elsewhere in the budget. Legislation to approve the increased quotas and voting reallocation should, therefore, be tied to the exceptional access framework, which will also provide additional transparency and accountability. It seems to me that with the global financial system in an uncertain state of flux right now, it's an important time, a good time for such reforms. Approving the international quota agreement in a way that helps ensure that these new resources are used strategically, effectively, and with accountability, as I show in more detail in my written testimony, that would be an important pillar of any such reform movement. Thank you, Mr. Chairman.
Gentleman yields back. And with that, we are going to go into our question period, and I'm going to recognize myself for 5 minutes. Ms. Lunsager, when you were our executive director at the fund, I'm assuming, I don't want to put words in your mouth, but I'm assuming you advised Treasury that a systemic exemption for Greece was a good idea. Was that accurate?
Thank you, Mr. Chairman. As you may be aware, the systemic exemption was inserted in the Greek program that we approved in May 2010, and there was no advanced discussion of that. So at that point, I recall we were all very concerned about the situation in Greece, and of course, any country has the right to ask for assistance from the IMF, and the IMF responds. And at that point, Greece was committing to a number of measures, adjustment measures that would start to address some of their problems. And to be perfectly frank, at that time, we were very worried about the rest of Europe. And my concern was that if contagion spread to a number of other countries, not just the smaller ones, such as Portugal and Ireland, who eventually needed IMF programs, but the larger ones, Italy or Spain, you remember the references to those, the GIPs or the pigs years ago, that the IMF would not be able to handle, for instance, an Italy with a great difficulty, and that it would be very difficult for the Europeans to hold the Eurozone together, given that they had not built their own firewalls at this time. So the systemic exemption in the end was inserted by the staff. The board approved it, although it was really, many of us just became aware of it at the meeting itself, buried in this long document. I was a bit dismayed staff used that approach, but in the end, my concerns about Greece and about Europe overrode those concerns, and I supported the program.
So, do you still, in retrospect, do you think it was a good idea? This is something I asked Secretary Liu earlier today, and after a rather lengthy sidestep, he came out with yes, he felt it was still a good idea, at which point I was asking him, just as Professor Taylor was talking about, the potential return of that language to that. And as I've been having some conversations, I too am finding support within the IMF and other countries that are involved with the IMF. And so, I mean, do you think it was still a good idea? And what's your take on whether we should return that language and return to that policy?
Whether or not we have that particular language, I still feel that the IMF needs an ability to exercise judgment, and by the IMF I mean the Executive Board, the membership itself. My concern with rigid rules is that, first of all, it's very difficult to know what the next crisis is going to be, and what we found when we had the exceptional access criteria first set, each case ended up being different and didn't quite meet the criteria. And so I'm not comfortable with being able to predict what a future crisis might be and how a country might or might not meet, particularly rigid rules. I'm also a little bit worried that these criteria are based on IMF calculations of debt sustainability, and these numbers are very difficult to pin down and very dependent on numerous assumptions, as I'm sure you're aware as you look at a number of these issues just in terms of the United States itself. So I'm a little bit worried that it could end up being very arbitrary, and if it's a key U.S. ally and the fund says, well, we're not ready to do exceptional access, okay, United States, you're going to have to do it all bilaterally, we're back to the very place that we did not want to be, or else we're forcing that country into a debt restructuring immediately.
Okay. I've got a little over a minute. Dr. Taylor, I mean, you were there and helped develop the exceptional access framework at Treasury. How do you respond to Ms. Lunsager and sort of your take on the world right now?
Well, I think there's quite a bit of flexibility in the way the original access rules or framework was put in place. So I don't think you need any more, and I think ideally you'd go back to something like that. I think the experience has also shown that it's been a disadvantage. I mean, you think about the danger of lending to an unsustainable debt situation, you end up bailing out the private sector. I mean, that's basically, if you think now, who owns most of the Greek debt? It's the public sector. So it enabled the private sector to get out.
Between the IMF and the EU?
Yes.
Or the ECB?
So that's the concern. I also think it creates an enormous amount of uncertainty. In talking to many in the private sector, they would prefer to go back to where we were because they recognize this creates uncertainty. So for all the reasons you want to have a framework, also I would say for accountability and transparency, this is money that you're going to have to authorize and appropriate. I think it's part and parcel to the institution describes as best it can its framework for allocating these large sums of money. So it's not rocket science, to be sure, but I think it's quite workable.
All right. And with that, my time has expired, and I recognize my ranking member, Ms. Moore, for 5 minutes.
Thank you so much, Mr. Chairman, and I want to thank all of the witnesses for joining us today. This is truly an opportunity, I think, for the committee to get a tremendous education with the aggregation of experience that you all have. I want to continue to pursue the discussion, maybe starting with Professor Taylor. I can truly identify with your notion, perhaps, that there's some moral hazard in abandoning a framework where riskier loans, countries like Greece were enabled to access the lending facility. But I hearken back, I was here when Secretary Paulson came and said, give us $700 billion, else the United States economy is going to collapse. And my first reaction was not a very ladylike response. It was like blank no. And as I listened to experts such as yourself, I concluded that it just had to be done. And there was moral hazard. I think we're still experiencing it. I think we sort of bailed out the private sector more so than we did homeowners. And so I am wondering, so I guess my question to you, sir, and to Ms. Lunsager, and perhaps Mr. Lowry would be, what do you make of the, quote, high risk of international spillover, the exception being the high risk of international spillover? I mean, do you honestly believe that if the IMF is not in a space like Greece or the Eurozone or other things, that there will be no impact on our economy here?
Well, what will happen in a situation like that is the IMF will say, your debt is unsustainable, with high probability. There is no exemption for a systemic spillover. So therefore, unless your debt is restructured, unless the private sector comes in and says, we're writing down or reprofiling that debt, you don't get a loan. So, but the result most likely will be is the private sector will get involved in that. And so that's really what, and having a clear rule in advance, a clear process in advance, that's basically what you hope will happen. I would add a few things based on my own experience. It is nearly impossible to determine about this systemic spillover risk. It therefore is very susceptible to political maneuvering, and for people to claim there's this risk systemically spillover when nobody really knows. We discussed the difficulty of doing a sustainability analysis, what the likelihood is of the debt being sustainable. That does require numbers, but that is far easier than trying to determine the systemic risk.
Ms. Lutzinger, you have a comment?
Thank you. My fear is it's very difficult, first of all, for a particular country to determine insolvency versus illiquidity. But contagion, I think, is enough when you have the private sector jumping around. You see deposits leaving a country, leaving the banking system, which is very difficult because, as you know very well here in this committee, our banking systems are based on deposits not all being withdrawn at one time, and that this can then spread to other countries that have similar characteristics. We saw this in 2010. We saw more of this in 2011 in Europe, and you've all seen the market jitters right now as all this uncertainty about Greece remains in the market, and the brinksmanship going back and forth among the leaders in Europe. So yes, I was worried about contagion then, and I still think that's a main reason that we have the International Monetary Fund. Thank you.
Mr. Lowry, just very briefly, I think, at least you and Ms. Lutzinger have talked about the lack of leadership from the U.S. given its veto power and so forth in the IMF. If we don't sort of, adopt the framework, pay our dues, be the leader, what could ultimately be the impact? I'm thinking of the formation of BRICS, for example. Could you, any of you, sort of share with us what you think the consequences are of, a diminishing influence of the IMF and the rise of something like the BRICS?
It's a good question. I think that, look, my own view is that the United States should be taking a leading role. We helped form the IMF. We're the leading country in the IMF. If that means that we need to pursue some of the reforms that John Taylor's talking about, I think we should probably be looking at doing that. If it means to do some other reforms, we should be looking at doing that. But that does not mean we should be holding up going forward on an agreement that everybody in the world has agreed to years ago, that I think that most people in the United States, people that have sat in the executive branch, have actually think that this is a helpful institution for us to support. As to whether or not it means that the Asian Infrastructure Investment Bank or the BRICS Bank is going to be created, and those are the reasons it got created, I can't answer that because I don't know the mindset of the Chinese. I do know this, that there is concern that the United States is not stepping up as an international leader in a number of areas that are not just about the IMF. And this is an area where I think that we can come to an agreement if we work hard together.
Thank you. My time has expired.
The gentlelady's time has expired, yes. With that, we go to our Vice Chair, Mr. Mulvaney, for 5 minutes.
Before we come back to Greece, I want to follow up very briefly on what Mr. Lowry just said to speak to the issue raised by the lady from Wisconsin, which is on the 2010 reforms. We've had some hearings on that before, back when John Campbell was the subcommittee chair here. And if I remember correctly, one of the fundamental principles of the reform was that we're going to move money out of the new agreements to borrow and into the quota.
Yeah.
And I remember an issue coming up at the hearing, Mr. Chairman, which was essentially those two pots of money, for lack of a better word, are subject to different rules, different governance. And my understanding, correct me if I'm wrong, is that while the quota system is subject to rule essentially by consensus, the NAB, the New Agreements to Borrow, is subject heavily to our veto. That's my understanding. Am I wrong about that?
So I think the rule for the NAB is that it is activated every 6 months. So on that, the United States has a veto right.
Right.
However, if there is a loan provided by the NAB, it is done on a majority
Yeah,
decision.
but we can shut it off, and that's my recollection. We could shut it off every 6 months. And I guess, Mr. Lowry, to your point, Ms. Moore, to your point, that was one of the hang-ups we had, was that we're effectively moving money out of an area where we had considerable control and into an area where we had less. That concern remains. And then I look at that concern against the backdrop of what we're talking about today in Greece, and the difficulties that some of us have with the changes that were made regarding contagion, regarding systemic risk. Now, Ms. Lunzager, you said something. I'm not interested in debating what happened with Greece several years back, but you did say something that I thought was relevant to the discussion about whether or not we should go back to the old rules as we go forward. And you said that the Europeans did not have firewalls in place at the time, and that in part justified changing the rules in the IMF in order to allow the IMF to participate. Those firewalls exist today, don't they?
Yes, Congressman, they have built firewalls, and the European Central Bank is taking a number of actions. With that said, each country is still entitled to seek help from the IMF and to seek advice and to seek a program.
Fine with all that. Fine. Not trying to change the underlying rules, just try to talk about whether or not that special exception, when we're not going to look at whether or not they can pay the debt back, for example, if we fear contagion. And my point to you, I think, is that the firewalls that you said did not exist, accurately so, several years back, do exist. So the need, perhaps, for the special exceptions for contagion have gone down. I also think that we need to recognize the fact that while the Europeans were not ready at the beginning of the Greek crisis, they've lent them like 8 times more money than the IMF has in the last couple of years. So, I mean, while the IMF's $25, $30 billion was critical at the time, it pales in comparison to the couple $100 billion that the Europeans have lent them. This seems to be their problem. The contagion was the countries that you mentioned, all European countries, so it seems like it might be more appropriate to let them take the lead. Mr. Taylor, you've had some thoughts, and I want to get some more input from you in my last 2 minutes on why you think we should make the changes and how you think we should go about the changes. So with the rest of my time, sir, I'll open up to you to help the committee understand why you think it's critical that we go back to the old rules and get rid of these special considerations for contagion.
I think the old rules worked. We thought about them a lot in advance. Other people thought about it. They were put in place to address exactly these problems, which was spillover, emerging market crises, which were very common in the 90s and continued into the early 2000s. So it was part of a reform to really provide some guidelines or limits to what the IMF would do in these circumstances. It was essential, in my view, because otherwise it was very ad hoc, very uncertain, and in fact causing the problem. So it worked well as far as we saw it in advance, and in practice it worked well. Moreover, when we violated it, it's been a disaster. So a lot of evidence, it seems to me.
Examples of where we violated in the past?
Greece.
Okay, so that's where we are today.
I mean, Greece, yeah.
Yeah. And I guess to the extent that we're still talking about it, doesn't seem to have solved the problem. I think Ms. Lunzager admits that the contagion risk is still there as of today. And I would suggest that the $30 billion that we put in, or excuse me, the IMF put in, probably did make the difference one way or the other, but then we're always charged with the problem of proving a negative. I hope we get a chance to get a second round with that. I'll yield back the balance of my time.
Gentleman yields back, and with that, the chair recognizes Mr. Heck of Washington for 5 minutes.
Thank you, Mr. Chair, and thanks very much for holding this hearing. My gratitude as well to the panel. You possess an amazing depth and breadth of expertise in this area, and I'm genuinely grateful that you would share your time here. I just have 2 questions, if I can get to the second one even, however. I'd like each of you to answer the following, beginning with you, Mr. Lowry. Given that the U.S.'s attempt to dissuade other major economies from joining the Asian Infrastructure Investment Bank led by China failed somewhat miserably, what strategy would you recommend that we pursue as a result of that? And I'd like each of you to answer that question, if you would, please.
In terms of the IMF, I think that I agree with most of what John Taylor said in terms of some of the reforms. I think that my own view is that the legislation should be rewritten with conditionality into it, but I don't think that I would hold back the authorization and appropriations while we try to solve the problem that John is trying to get at. I think that that should be part of the conditionality of the legislation, and that the Treasury Department should work on behalf of Congress within the IMF to actually make the types of changes John is talking about. So I think that is the way I would try to approach it, as opposed to taking too unilateral a stance, which obviously in the Asian Infrastructure Investment Bank we did and failed.
So if I heard you correctly, you would have Congress pursue that particular avenue of action. I guess the question, given that we haven't been able to do that very well, is absent that, what should we do?
Well, I'm here to say that I think that we, the United States, through the Congress, should be pursuing an action of supporting the IMF. I believe that strongly. I believe that that can be done in a way that's conditioned. I remember sitting in the executive branch going through many conditions on the IMF, the World Bank, and many other different institutions in which we were able to meet the obligations that Congress set upon us. They were not easy, but that doesn't mean we couldn't do it. I think it could be done here.
Professor Taylor?
So I think the reform of the exceptional access framework, the U.S. would not be unilateral here. There is a lot of interest in doing this. As I mentioned in my testimony, staff and the management of the IMF seem comfortable with it. So it's, in a way, its expression is almost a slam dunk for the administration to say this is fine. I think, I don't know what members will do. I'm not part of any negotiation, but this is something that several members seem interested in. It seems to me the administration knows that they have allies. The U.S. is influential anyway in these discussions. I think it could move very quickly.
Ms. Lunziger?
Thank you. I would agree with what Mr. Lowry said, that I would hope Congress could move forward and approve these 2010 reforms, and at the same time continue to work with the administration as they work with the IMF to pursue reforms. I think it'll be a challenge among the membership to come up with an agreement on how to deal with this going forward. And I think one of the difficulties will be, under this new framework the IMF is talking about, IMF, by standing back a bit and limiting its participation, will either be forcing the country into an immediate debt action, when it may not be clear if it's insolvency or illiquidity, and at the same time then looking to bilateral creditors to step up to the plate, to fill up the remaining gap. And then I fear that the next crisis country that comes along will be a key U.S. ally. And then the IMF will be turning to the United States. The United States administration will have to come to Congress and seek the authorization and appropriation for a bilateral support, which, as I recall, has been very difficult even for the very low-income countries such as Liberia or Haiti that we seek to support. But coming up with concessional resources for middle-income countries, I think, would be a real challenge. So I fear that we, the United States, as an official bilateral creditor, might be turned to in a bigger way and more frequently, and at a time when we have our own budget considerations and we're focusing on our other priorities. So I'm not so sure this new framework is going to work out quite so smoothly. Thank you.
To you again, ma'am, I hope an easy yes or no. It's not, but I'm going to do it anyway. Is there a point at which failure to enact reforms renders it all irrelevant, because the fact of the matter is other institutions will have developed over that period of time? How long before we're really in the pinch here because we haven't acted?
I can't really put a time frame on it, but it's clear the BRICS, China are moving ahead in a number of areas, whether it's balance of payments backstops for each other or these infrastructure and BRICS Bank. And then the Chinese are gung-ho on asserting their global leadership. And I'd really think it would be terrible if the U.S. conceded that, when over the years I found, my many years in government, that countries valued United States leadership. and valued our participation in the international system and our engagement and our listening and our working out what the solution should be to different problems. And I think we should reassert that leadership by getting these reforms done. Thank you.
Thank you for your forbearance, Mr. Chairman.
The chairman has been rather generous, yes, with those, but happy to do so. With that, I'd like to recognize Mr. Pittenger of North Carolina for 5 minutes.
Thank you, Mr. Chairman. Thank each of you for being with us today. I was troubled and really amazed last week, I guess it was. I picked up the Journal, and there was an article by the President of Greece rebuffing the European Bank for the reform demands that were being required of him. And I thought, how pompous, you know, I owe you money, and yet you have he had the ability to go back to them and say, how dare you make those requirements? I just imagine myself going to my banker, and that I owe money to, and challenging my banker, how dare you make these demands? But it brought me to more clear focus of a different person, Margaret Thatcher. I had her in Charlotte some 20 years ago for a dinner to speak of the challenges that she met in Great Britain when she was Prime Minister. And all the enormous amount of rebuff that she received and really difficulty in trying to bring restructure and reform to her government. Well, go 20 years further, nearly, a couple years ago, I was with a member of Labor, and we were riding in a bus out to Fenway Park. Joe Kennedy had invited us to come out there for dinner one night, and I just reluctantly brought up the name of Margaret Thatcher, wondering what she would say, and knowing the darts would fly. And her comment was, God bless her. She saved our country. Without Margaret Thatcher, we wouldn't be where we were today. So I think my question is, the flexibility of exceptional access, has it created the lack of commitment to austerity reform? Is that flexibility created the lack of commitment or interest to pursue that they feel like that, well, they gave me one time, they'll be lenient again, and not make that full commitment internally to do what's necessary? Was that part of the case with Greece? You can each respond.
I think briefly, the concern, it's sometimes called moral hazard, is if countries and their people recognize that there's going to be an increased chance to bail out, they'll be more reluctant to make the reforms or the things they need to do. I've always wondered how do you prove that kind of thing, but I emphasize more the uncertainty that's caused by the lack of a framework. But I'd say, in addition, it's not simply the exceptional access framework or not that's the situation in Greece now. It's a lot of other things happening. If you look at the structural things the IMF wanted them to do, they make so much sense. They're really just moving towards more markets and less intervention by the government. And of course, this government in Greece is not interested in that. And so I think that's really the problem. The structural reforms they have to do are clear, but they just don't want to do it.
If you don't mind, I will weigh in for just 1 second. I think it depends on the case. Portugal and Ireland were in not similar situation, but pretty bad situation just a few years ago. They have actually taken on very tough economic reforms in their country, and frankly, if it wasn't for Greece dragging down sort of the rest of Europe, people would be celebrating how far and how much progress Ireland and Portugal have made during that time. So it's a tough argument. I think it's a good point that you're making about whether or not, if you put so much money on the table, do governments have a tough time taking those tough steps? I think it depends on the government.
Sure. Thank you.
Thank you. I would agree with what Mr. Lowry just said, and frankly, I would also look to the countries that didn't seek IMF programs, but nonetheless undertook very strong reforms, such as those in the Baltic area, Slovenia, some of the others in Europe have really, look at Poland over the years, without seeking IMF support, and they've done it because they think it's in their own interest and that it's important for their unity with the European Union.
Thank you. I yield back.
Gentleman yields back, and Mr. Kildee of Michigan has decided to pass, but I will recognize the ranking member again for 5 minutes, and we're going to start a second round as well. We still have a few more on our side. But with that, Ms. Moore.
And thank you, Mr. Chairman, and again, thank the witnesses for sitting through a second round of questioning. Mr. Taylor, Professor Taylor, rather, I want to go back to you. You spoke in the first round about, we were finishing our discussion, I didn't get to go any further, about how Greece should restructure its debt. That's what they should have been required to do. And in the Wall Street Journal, you did an article talking about sovereign debt collective action clauses. And I guess I wanted you to expand a bit on these clauses. Let me tell you what the thrust of my question is. I'm concerned that taking the board's discretion away, not having any flexibility, will impede the operations. Just is not workable. So under what circumstances should the IMF require restructuring versus kind of reprofiling a country's debt? You say it should be part of a preset requirement, but what would be wrong with sort of a case-by-case basis within some framework?
Well, a framework in its own sense has less case-by-case to it. There's a treatment of this is how we're going to treat people or countries in different circumstances. It sort of lays out your strategy to do it. There are different cases, and whether that's sustainable or not sustainable, for example, that creates different cases, but you say how you're going to treat those different cases. So there is flexibility in the sense you've laid out your strategy, but that's laid out in advance as much as you can so people can understand it, and so we can assess whether it's working or not, and see when there's exceptions to it. Okay. I think that's the way to think about it. There's always a sense in which, especially if you're in public policy, you'd like to get around that framework. You'd like to, for some reason, do it differently. I've been there myself. I know what happens. Somebody get a call from somebody who says, look, there's something wrong here. Our bank is in trouble. Could you help us out? And you want to be able to resist that because, no, you got your principles, you got your rules, you got your strategy in place. If it becomes all tactics, it becomes hopeless. So I think that's the...
But the whole point of this hearing is to talk about, moral hazard versus contagion. And I guess I'm concerned that completely abandoning the new regime that's being proposed would of course help us avoid more moral hazard, just to say, we're not going to lend to you. But I guess Ms. Lutzinger, Mr. Lowry, do you think that would increase the contagion?
Thank you. I would be a little bit worried because I fear that if they set this in place, there's going to have to be some sense to everyone, the market, everyone, what's the number? What's the debt to GDP number? That's going to be the cutoff. I mean, of course, we have the Maastricht numbers in Europe of 60%, and we've seen how well that's worked. But we don't know really what's sustainable in countries. And so in Ukraine, they've set a goal of 70% of GDP. In Greece, the goal was set at 120% of GDP after. I mean, how do we know what exactly is sustainable and is unsustainable? And my fear is that we'll be U.S. authorities would be faced with the situation of a country saying, no, I'm going to take the measures, I'm going to adjust, I want to honor my debts. I mean, Brazil did this early in the 2000s. They were not going to restructure, even though market commentators all over the place were saying Brazil would have to restructure. They did not restructure. They had a fund program. They drew on it. They adjusted and turned things around. And so it's very hard if you have someone like that calling the White House and saying, no, I'm not going to restructure my debts. The fund's pushing me into something that's not needed, for the U.S. bilaterally to resist that, right, if it's a key U.S. ally. So I think we need to keep the flexibility. Thank you.
On my part, you're talking about a very, very tricky issue, which is the nuances of moral hazard and the nuances of contagion. I am not a humongous believer that there is moral hazard to countries. I am a believer there is moral hazard to lenders and to investors. But could there be contagion? I think the answer is yes, but that does not mean that we should have the exceptional access or systemic exemption for the exceptional access does strike me as a loophole that is extremely large. And so I would want to tighten it up, whether it's going back to the proposal that John Taylor is talking about, going to the proposal the IMF staff is pushing. I would want to close it up a bit because of that worry.
All right, the gentlelady's time has expired, and with that, still I need to correct a slight misstep on my part. We're supposed to go through our entire round first before we are recognizing again for the second time. So
You're so kind.
I'm here for you, Ms. Moore. So with that, I'd like to recognize a new member of the committee and the subcommittee from Minnesota, Mr. Emmer, for 5 minutes.
Thank you, Mr. Chair, and thank you to the ranking member and the panel. Thank you for being here. I think I'll be brief. It's interesting getting up to speed, and I appreciate the information and all the background materials. The IMF, along with the World Bank and the World Trade Organization, have been around for 70-some years. The IMF had a different initial purpose that changed in 1973 primarily when we adopted a new system of floating exchange rates. And I think today this institution plays a major role in monitoring the economic and financial policies of member countries. I think, Mr. Lowry, you started off by saying there are 3 specific tools: technical assistance, surveillance, and lending when necessary. It caused me to wonder about the surveillance piece. Where are we at today? And this is for all of you. But if surveillance has been a tool of the IMF since the 70s, maybe even before, since the beginning, why wasn't the alarm bell sounded well in advance of the Asian crisis? Why weren't we given warnings through the IMF about the crisis in 2008? And I mean, we've talked plenty about Greece, but could you just, amongst the 3 of you, whoever wants to, address where's the surveillance at? Why wasn't it? Why didn't it work back then? Or maybe it did work and we just didn't hear about it. What needs to happen in the future?
My own view is the surveillance piece of what the IMF does is probably the most important piece. It's the least talked about in some respects because there's not really money involved. In terms of getting it right and understanding exactly whether or not is a country on the verge of a catastrophe financially is a hard thing to do. Markets don't get it right, and there's obviously people making a lot of money out there thinking about this. And official sector actors don't get it right. But I think that the IMF does a pretty good job of looking at a number of countries as to why they didn't get this right or that right. I think that sometimes their advice is not listened to, so that can't be on the IMF. 2, sometimes they just get it wrong. I mean, they're good economists there, but at the same time, it's hard to see sometimes where the crisis is going to come from. We look at our own country. How many people surveil, analyze, think about the U.S. economy? Only a handful got it right back in 2006 and 2007.
Which I appreciate. And Professor and Ms. Lunsberger, please take it the next step. But you've had 2 major ones in the late 90s and then 2008. We weren't just talking about one country. We were talking about a whole bunch. The question is, why and what's been done to hopefully improve that so that doesn't happen in the future?
So I think the surveillance with respect to other countries is important to think about, not just the major countries. And also that verges into this third role, technical assistance, which I think is very important. There's a lot of countries that just don't know about even budgeting or about monetary policy, and so there's actually good advice that can be conveyed. I actually think that in a way there's another maybe it should be a fourth category. It's possible to have programs without loans. It's got something called a program support instrument, I believe. But it's effectively like a IMF program where you lay out, here's our strategy. It may be like a debt reduction strategy. It may be a way to get inflation down, whatever it happens to be. And if the IMF works with the country, it doesn't have to be a loan. Frequently, the loan is the way they engage, but there's other ways to do it, which I would prefer. You engage with them and you help them, and there are people who haven't really done much before, and the IMF does have expertise on that.
Thank you, John, for mentioning the policy support instrument. I agree that that's been very important, and countries have liked that. In terms of the IMF engaging in surveillance, what's been really important is that the IMF has conversations with officials, the annual Article 4 review, and at that one, the IMF will raise its frank concerns. So in 2008 and 2007, it was raising concerns in the United States about the subprime loans, even though the broad view across the Federal Reserve System, across many commentators, was that, oh, we can handle this. These loans are a small part of our mortgage side. Well, it turns out it wasn't such a small part, and it was a problem. But at that point, there wasn't agreement that it was going to blow up the way it did. So the strength of the IMF is to bring issues to the fore and to raise them with the country authorities and to say, you really ought to be worried. We see imbalances emerging here that perhaps you're seeing your debt having to be more and more short term. You're not able to issue longer term debt in an emerging. So I think the IMF has done a very good job on that. But sometimes that's more private than public, because the IMF, of course, doesn't want to be the cause of a crisis by saying, oh, it's headed your way.
Thank you. My time's expired.
The gentleman's time has expired. With that, we recognize gentleman from Arizona, Mr. Schweiker, for 5 minutes.
Thank you, Mr. Chairman. And a small attempt to sort of go on the theme of the hearing, the moral hazard. But I'd like to do this slightly more conversationally, because some of this, I want to sort of do the Wayback Machine, the last 25, 30 years. From the 80s to the 90s, being someone that was very interested in the tequila crisis, when the Asian tigers, having been in Thailand, on my way to India when all hell was breaking loose. What countries, through IMF and other bilateral agreements, kept their promises, demonstrated a level of discipline, and where did we create almost a cycle where, once again, we see Argentina unavailable for comment, or constantly. So walk me through this, and then as we're doing this, I've always had a concern about some of the debt swap mechanisms, particularly when it's private capital being swapped out and making sure that it's does not become sort of a bailout mechanism for either bad credit decisions or large industries or large banking institutions that are ultimately swapping their debt position for what eventually is taxpayer money from around the world. Mr. Lowry, could you start with this? What's worked and what hasn't, and debt swaps?
Well, I think that what works usually is when the countries themselves make the reforms. It's not about the IMF imposing those reforms, and the IMF will try to impose those reforms as part of its conditionality. But when the countries start adapting those reforms, so you pointed to Mexico back in the tequila crisis, the Mexican authorities took very, very difficult steps over the next few years after the crisis in 1994 and 95. To the point where the ruling party lost its power in 2000 for the first time in 70 years.
And that also had an additional 50 billion through U.S. taxpayers,
yes,
managed by IMF, but
no, the IMF did not manage so the taxpayer money.
I thought that the 50 billion came from from a special.
The Exchange Stabilization Fund within the Treasury Department.
But it wasn't, those dollars were managed through IMF, I thought.
No, that was actually managed through the Treasury Department. It's one of the few times the Treasury Department actually kind of worked almost like the IMF during a crisis. Another example would be Korea back in 1997. An example I know that John worked on very closely, which would have been Uruguay. So during the Argentina crisis, which you mentioned, Uruguay also went through a crisis.
Because of the limits of time. So your model basically is when the countries produce the list of reforms themselves, we have better outcomes.
Yes, when they are very serious about
Professor
making
Taylor, tell me, what's worked out there, what hasn't, and your vision of what happens.
Well, I agree with that part for sure. I think there's other things. That's the nature of the engagement. I like to compare Russia in 1998, where there was contagion. That decision was a shock not to continue funding. It had to do with politics, concern about the nuclear arsenal, et cetera. It wasn't really an economic decision, and there seemed to be a lot of contagion. Then you move 3 years later, and while Argentina was a problem, there wasn't contagion when it defaulted. It was really zero. And that's, I think, because the nature of our engagement was very clear, what we were going to do, when we were going to do it, and also there was this sense of trying to help Uruguay and Brazil nearby. So you had another way rather than just to do the bailout. So I think the nature of the program matters too.
Okay, Ms. Lunsford.
Thank you. I think the ultimate goal, or the immediate goal of fund programs, is for countries to adjust enough, restore confidence, and resume borrowing from private markets. And I think we've had a number of successes in that case, and we've seen it in Europe, successes in terms of Ireland and Portugal, turning things around.
But if I were to look at our last 25 years of history of participation, what would you consider our greatest failure and our greatest success? And what was the difference?
I would say our greatest success is managing to convince the world that we still believe that being multilateral is important, that the United States is deeply engaged with the rest
I was
of
trying to get it down to a country level. I know that's more uncomfortable, but
I would say Mexico.
Okay, so Mexico post-94?
Yes.
And what do you believe are our greatest failure?
Well, I would say the system, what's going on in Greece right now, is a failure on the part of Greece and a failure on the part of everyone else as well to be able to put this together.
Any quick comment in my last couple of seconds on my debt swap concern?
Yeah, I'm sorry, I didn't quite understand what you meant by debt swaps.
IMF comes in, provides bilateral loan, and it's often used to pay off or move money around to pay off other obligations that are privately held.
Yes, at times the fund does help countries honor their current obligations, and that can include paying off some of the private debts. But as I said, the goal is to restore enough confidence that in a very short amount of time, those private creditors do come back to the country.
All right. Yield back, Mr. Chairman. Within that should be a conversation of what haircuts should be required by all participants. Thank you, Mr. Chairman.
The gentleman yields back. I will note that you have definitely gotten the attention of every intern on Capitol Hill talking about haircuts and tequila crises. So I was
getting worried.
There's great worry happening here on Capitol Hill. But with that, the chair recognizes the gentleman from New Mexico, Mr. Pierce, for 5 minutes.
Thank you, Mr. Chairman. Appreciate each of you being here. The Wall Street Journal said earlier this year, I think it was, that the IMF departed from its own regulatory rules and limits in order to make the loans to Greece. Is that a fair characterization, Ms. Lunziger?
Thank you. That was what we've been talking about in terms of the IMF changing the exceptional access rules when the staff and management asked the board to approve the program in May 2010.
I found it amazing. I asked earlier this year to Secretary Lew that same question, and he said that he didn't believe they changed anything, that they were acting with the same rules as before. I found that to be an amazing statement. What impact is the failure of Greece to pay earlier this week or whenever it was, they didn't make their payment? What impact is that going to have, Mr. Taylor? I would look at you on that. What's the impact going to have worldwide on the confidence in the system?
Well, it's very unusual to do this, although technically they can bundle it, I understand it. If they really completely go into arrears, then that's really damaging to the IMF. And I hope that doesn't happen, but it's on its way. It's actually, I think, for me, in our discussion, an illustration of some of the problems I think you get into when loans are made to countries whose debt is just nearly not sustainable. I wouldn't say I want to blame all this on that. There's obviously many other things, but I look back as what if in 2010 there was then a serious restructuring of Greece as part of that loan. It would have made it much easier for Greece to start making the adjustments, but it was delayed, and then they had a restructuring, and it was sort of part of, people hoped that would be enough, and many said it wasn't enough. So I think addressing the problem at the time would have made a difference, and it's a counterfactual, you don't really know, but I think to me it's an example of why you need those frameworks, and why changing them, especially at the same time you make the deal, I mean, that's probably the most disturbing.
Thank you, sir. Ms. Lunziger, I've read reports, I don't know if it's accurate myself, but in the surveillance of country policies, one of the reports is that Greece is having trouble because up to 40% of their population just refuses to pay the taxes that they owe. In other words, it's well characterized, and so is that something is that report somewhat accurate?
IMF staff reports have highlighted the problems with revenue collection, and that has been an element of the program from the beginning. So the Greek authorities are working on making the revenue administration more independent and doing a better job to have their own citizens.
And my quandary is, people, the average pay in my district is probably $31,000 to $35,000, and I have to go back to that district and explain to them why I should use their money to pay for people who refuse to pay their own taxes, to bail them out. And I understand what you're saying, that the entire world system is kind of on thin ice, and if we don't do anything in the Eurozone, then we have spreading problems. But to tell you the truth, people just barely making ends meet in New Mexico, they could hardly care. And I'm not sure I'm willing to make the case to them. So that's...
No, I mean, I insisted on that in every statement I made on the Greek programs, absolutely.
I appreciate it. Mr. Lowry, one of the things that I see a lot in the press about is that the IMF has recast itself, that they were facing the irrelevancy, or whatever the words that one of you used in your testimony, and that one of the things they're doing in this reinventing is placing themselves where they can become the world's reserve currency with the SDRs and getting some gold to back that up. Is that a real possibility, in your opinion, that becoming a world's reserve currency?
No.
Mr. Taylor?
No.
Mr. Taylor, how about you?
No.
You don't think it's a possibility?
Part of the SDR, that's a different question.
Yeah, the SDR is a reserve asset for how the IMF moves money among its members. It has nothing to do with how
Have you seen
you and I go buy a candy bar. We're not using an SDR.
Have you seen those reports that are saying that they're positioning themselves to take the place of the U.S. when the U.S. debt, when people lose confidence in our currency?
I haven't seen those reports, and I wouldn't put much stock in them.
Okay. All right. I see my time has elapsed, Mr. Chairman. I yield back.
Gentleman yields back, and still seeing no additional members, new members on the Democrat side. We will continue with our side for our first round. Mr. Ginta from New Hampshire is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Professor Taylor, you touched on something a little bit earlier that I'm interested in. When I go back and look at the categories of focus of the IMF, lending, technical assistance, and surveillance, you touched on what I think you referred to as possibly a fourth area, program, what you called program support. That's something I'm very interested in, because I subscribe to the notion that, as what Mr. Pierce was saying, this concern that constituents have about utilizing taxpayer money to bail out people in foreign countries. So it lends to the argument or the discussion of how do we change the mission or modify the mission of the IMF. So you touched on it a little bit, but could you talk about, in the context of trying to keep balance within the financial world, what program support without a loan program could look like, and how that would differ from what we're doing relative to, say, Greece? When we bail out, they fail to make a payment, and you see front-page news as a result of it.
It's actually, it's been done, policy support instrument, because the word is policy, not program support instrument. And the goal is to have the same kind of program you would have as if you gave a loan to a country, with payments and tranches and all that, except you wouldn't have it. You engage, you could think of it in our context. I just testified at the Budget Committee this morning. As you know, the resolution has a 10-year program to reduce the deficit to zero in 10 years. So that's like a policy. And so now you consider another country who wants to implement such a policy, and the IMF helps them with it. And they don't have to give them a loan to do it. They just help them with it. They maybe have meetings at certain dates. They have benchmarks to make, and it can work very well. Traditionally, that's been done in the context of a loan, but you really don't need a loan in many cases. And the loan kind of screws things up. It's so often debt becomes a major problem in our engagements. So I think it's a great idea. I hope they do more of it.
Should we be considering what the debt to GDP ratio is in how we, and I want to ask this of Mr. Lowry, how we consider the countries to which the IMF loans?
Yes, I mean, I think that is a helpful statistic in terms of trying to figure out the debt sustainability of a country. And this goes towards kind of the aspect of if a country gets into a balance of payments problem, so not the policy support instrument you guys were just talking about, but an actual balance of payments problem, one of the measurement tools that the IMF will be looking at is what is their debt to GDP. So what does their debt profile look like going forward? What is their stock of debt going forward to make sure they're trying to make a judgment, is this a liquidity problem or do they have a solvency problem? Right. And that, I think, should help you make an argument as to what could the IMF do to help in that situation, and do you need to go to a situation where the IMF can do something, but they can't do all of it, and so there needs to be some debt reprofiling or debt restructuring or what have you.
So in the circumstance of Greece, would this look more like, would you identify Greece as more of a solvency problem than a liquidity problem?
Yes, and I think the IMF would say that too, and remember, Greece has gone through two sections. In 2010, it was IMF money plus European money on the table. In 2012, it was more IMF and European money, but also they restructured and took a big haircut, to use the words that were used earlier, on private sector creditors. And now we're in a situation now where the only creditors left, pretty much, I think it's about 80%, are official sector creditors. And you do see reports out of the IMF that they think European members are going to have to potentially take a haircut themselves going forward.
As a result. What's the debt to GDP ratio for Greece? Do you know? Rough guess?
I'm guessing it's about 175%.
Okay. So I think I heard Ms. Lungsinger say earlier, I don't want to put words in your mouth, but I thought you said something like it's sort of difficult to specifically pinpoint what that ratio should be. But I think it's probably fair to say, I mean, logically people would argue that that kind of ratio is excessive and is not liquidity, it's solvency. So it would stand the reason that a program support approach, in my view, would make more sense in the context of Greece, at least at that level. Is that fair to say, Ms. Lunsinger?
I think that's a possibility where the IMF could be there providing advice and helping put the overall economic policy program together. And then the Europeans and the private sector through a debt operation would provide the financing. That certainly is a possibility.
Thank you.
Gentleman's time has expired. We are going to go into round two, and as I've been consulting with my good ranking member, we have, she has slid into that round two before we were supposed to. Mr. Heck is choosing to pass at this point. So going into round two, I am going to take my 5 minutes, may not use it all, but I wanted to touch on a couple of quick things. It's just I've been listening through all this. I'm curious, Secretary Taylor, in your view, returning to Greece and sort of the systematic exemption here, what would have happened had the IMF not stepped in? Would the EU and would the ECB have really picked up that slack, in your opinion?
I think it's quite possible. If early on, the Europeans said they didn't want the IMF in. The president of the European Central Bank, Jean-Claude Trichet, originally had that position. So at the time of 2010, I mean, I wasn't in the room, but my sense is the Europeans could very well have started providing the loan support. It may have been that they would have asked the IMF to monitor. It wouldn't have been called a policy support instrument, but the IMF could certainly have monitored the framework and the conditions. But I think that's one possibility. The Europeans talk most about the spillovers. I think a lot of their banks were holding the Greek debt at the time, so they would be talking their bank's book, so to speak. I wasn't in the room. I don't know for sure how that worked. But another possibility would be very straightforward, saying, look, the debt is not sustainable. There's a lot of private people in the private sector who are holding this debt. If we're going to put some new money in, the private sector's got to think about reprofiling or more restructuring. And that's kind of the ideal, really. That's really what the exceptional access framework, if it's working well, that's what you'd want to have happen, because you don't want the public sector just to bail out. You want in the banking area, we call this bail-in, right? The Europeans call it bail-in now. Well, you want some bail-in these cases as well. So I think that's the ideal.
Do you believe that it was maybe more of an intent that the Europeans had or a belief that with the IMF getting involved, that they would come in and sort of play bad cop to their good cop with Greece?
I don't know.
Okay.
Sorry.
All right. I want to touch a little bit on Ukraine and the support of the IMF that they have. Last week, IMF stepped in and said it may go ahead with a $1.7 billion payment to backstop the country, even though the fund has been wary about lending to countries that are in arrears with private creditors. And obviously, Ukraine has a certain strategic importance to us and to Europe and the Europeans. And I'm curious, any of the three of you, how you view the IMF's involvement in Ukraine so far. Any of the three of you, feel free to jump in.
Okay, so let me say, this is, we put it in a broader context, and Ms. Longsager also referred to this. There is always a strategic aspect of our engagements with countries, and sometimes there'll be a strategic aspect of another country's engagement, maybe an African case for Europe. And I think it's really important to try to distinguish those as much as you can. Sometimes it's going to have to be there, but ultimately some of those things are going to have to be bilateral rather than use the international institution. I think the Uruguayan thing is very complicated because it's got both strategic and serious economic issues. And I say you just have to be wary in those circumstances. It's a way in which the exceptional access framework is a way in which you can bring the economic considerations in more rather than the political ones. I think that's generally healthy. You can't do it all the time.
Anybody else care to jump in?
Oh, sorry.
Thank you. I was just going to add that on Ukraine, I think, and I'm not part of this decision-making, but I suspect the point is to indicate that the IMF and the community, the executive board representing all the countries, wants to continue to support Ukraine so it can take the measures it's starting to take, reforms that are very much needed, and to keep the pressure on the private sector to come to the table and reach terms on finding a way to work and reduce the debt burden that Ukraine's facing. So I think that's why the IMF is going ahead, because Ukraine is still working with the creditors, consulting and negotiating, but the intent is to keep the country going too.
Yeah, the only thing I was just going to add is I think Ukraine's a very difficult circumstance. IMF's putting money in. They're actually taking a lot of the type of actions that John Taylor's talked about, which is they're actually saying, we need you to do a debt restructuring with your private creditors, which they're trying to do. And they're taking significant reforms of the Ukrainian government. The biggest problem Ukraine's got is Russia.
Occupation.
And that's creating huge financial and economic pressure. So they can be taking lots of reforms, but they have this significant problem right next to them.
Okay. My time has expired. With that, I will recognize our Vice Chair for a second round, Mr. Mulvaney.
Just a few things. Professor Taylor, to follow up on a question that the Chairman asked you, you mentioned that when the Greek crisis originally started, that the Europeans had expressed some concern about the IMF getting involved. Do you have any insights as to why they were apprehensive about that?
I really don't. I think the issue is, remember, the IMF lending to these developed countries is quite unusual in recent years. Emerging markets had been the focus. In fact, the exceptional access framework had been. So in a sense, the Europeans, I think, originally were saying, hey, this is our problem. We don't want the IMF here. The IMF is for those guys that are problem guys in Latin America or something. I think that was a concept that they had. I don't think I know for sure, but that's my sense is they will handle this. But then it just got too big.
Ms. Lunzinger, at that point, you were involved at that point, correct?
No.
Ms. Lunzinger was.
Yes.
I'm sorry. I'm sorry.
Yes, Greece, yes.
Any insights as to why the Europeans? Same question to you. I'm just trying to get a feel for the lay of the land in 2010, I guess.
Well, again, I wasn't directly in the conversations with the European leaders, but I understood that initially they felt that if it's the Eurozone, they should solve the problem themselves, which, of course, many of us were fully supportive of. But I think in the end, what happened was the Europeans realized they're going to need a real adjustment program in Greece, and that it was very difficult for the Europeans to do that bilaterally, to impose that kind of conditionality. And furthermore, for them to come up with the financing all on their own meant, and it did initially as well with the EFSF, they had to go back to each one of their individual parliaments for approval. So it took a while to
took some time, yeah.
Yeah, it took some time. So I think in the end they realized they needed the fund because the fund can move quickly and pull together the resources.
Come forward to an issue that I think Ms. Moore raised regarding bailouts. You mentioned bail-in, Professor Taylor. The money ultimately ended up where? At the beginning of the crisis, the majority, I don't remember the percentage, of the Greek debt was held by private financial institutions, Mrs. Moore. At the end, it had been socialized, held by governments and by the IMF. It strikes me that what the IMF did is bail out the private banks in Europe. Am I wrong about that? It didn't go, the money certainly didn't go to the Greek people, and to the extent it went to the Greek government, it was immediately paid to the private money center banks, correct?
No, I think that's a good way to describe it. It's not perfect. Bailout is an ambiguous term, but I think that's right. Originally, you had a lot of private sector holding debt, and now you have a lot of public sector holding debt, and so it does look like I think the word swap was used earlier.
And I know she's having to leave, but I do hope that our Democrat colleagues understand that some of us have a problem with that. And that if we're looking to reform the IMF, it may be to prevent circumstances like that. That's a very different thing for the IMF to do. If they were lending money to a third world country, to an undeveloped nation, that really wouldn't be as much as an issue as they are when they're lending to either emerging economies or even more so to developed economies. So anyway, I'm sorry to get a little sidetracked on various issues. Thank you very much for your time. I yield back.
Can I just make, there's one slight amendment, is that
Sure.
in 2012, the Greece did work with the IMF, and there was a fairly significant haircut to a number of private creditors. So I don't disagree with the premise of your question in the 2010, but in 2012 there was actually a lot of private creditors took a major haircut on their claims.
Thank you, Mr. Lowry. Thank you, Mr. Chairman.
Gentleman yields back. And in the effort, you're still going to pass, I believe. And we have had votes called. We're going to try and quickly get in one or two more, if that is okay with the panel. And with that, I'd like to recognize Mr. Pierce from New Mexico for 5 minutes.
Thank you, Mr. Chairman. Kind of following along the same line, and you may have already answered, I apologize, I've been in and out. But there's generally a truism in business that when the bank loan gets big enough, they no longer have a loan, they have a partner. And so was there kind of a conversation like that in the IMF as we're going up to lending to Greece, that we're lending at 3,200%, 3,200% of their quota share? Was there any conversation in the room? Ms. Lunzinger, I think you would be the one that might have been there.
Well, thank you. We were all very aware of that it was a large loan in terms of percent of quota. In terms of Greece's GDP, it was maybe around 12% of Greece's GDP. And of course, earlier we had done some fairly large programs. The Uruguay program was about 18% of GDP. And I always preferred that metric because quotas could be very much out of line with in terms of a country's real economic situation. So yes, we, I think around the board table, were very well aware of how big the program was. But it also was the sense that, and I went back and looked at the discussion and what I said, but at every board meeting I insisted that the Europeans reconfirm their support for their Eurozone partner, which they did.
They did give that support?
They did give that support. Of course, it's conditioned on the Greek authorities adhering to their program. But my bottom line is I still feel that it is very much the European responsibility to ensure that Greece honors its obligations to the IMF. I mean, the IMF has been a supremely valuable institution for Europe, not just in the Eurozone, but in European engagement with countries around the world. So I do look to my former European colleagues, their governments, to make sure that this problem is resolved. Thank you.
So you also mentioned that you had insisted that adjustments be made in the way that the Grecian authorities collect their taxes.
Yes.
You went ahead and voted for the transfer, even though I don't think they've made much progress in collecting those taxes. But you voted for the loan.
Yes, I voted for the loan, and I did support the reviews that came along the way. Again, because the Greek authorities were committing to take measures, they would have taken some parliamentary actions, and were committing to take additional measures. And we did start to see some improvements in some of the numbers, even though I think many of us were hoping that there would have been quite a bit better performance.
Okay, if the performance stays roughly the same as it is, and the question came up again, and they maybe weren't making their payments and asked for more money, would you still vote for it?
Well, no. If a country is not making its payments to the IMF, it's basically it can't draw on the IMF. And frankly, I mean, Greece hasn't been able to draw this past year while this program review has been under negotiation. But any country in arrears to the IMF cannot
Let's say
draw.
that they make their payment that was due. Let's say they make that, but they have not made the internal adjustments. Because I asked the German Bundestag, whichever was here, how long will your people tax themselves more in order to pay for the people who refuse to pay their own taxes? They understand that that's a ticking bomb that they're going to have to deal with at some point, because the Germans appear, when I visited there last, that was getting to be softer ground, that total commitment to the idea that we're going to hold the Eurozone no matter the pain was being felt at the ballot box, and that is the ultimate test. So if they made their payments and they had not made significant changes in their internal collections, would you still vote then if they were asking for more?
Well, I mean, it would depend on the constellation of what they were proposing they would do. I mean, it's very difficult.
Yeah, that's fair enough. I would yield back, Mr. Chairman. Thanks appreciate the input from all the panelists. Thank you very much.
Gentleman yields back, and with that, we have about 8 minutes left to go in our vote, and I am going to be calling an end to this hearing. I just would like to say thank you to each of our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their responses. I ask our witnesses to please respond as promptly as you are able to. And then also, without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the official record. And with that, this hearing is adjourned.